What if I told you that having $20,000 sitting in your savings account makes you one of the most dangerous people to your bank? Not dangerous in a criminal way, not dangerous because you've done anything wrong, dangerous because you figured something out that most people never do. Because here's the truth the financial system doesn't want you thinking about. Banks don't make money when you save money. They make money when you spend it, borrow it, and stay broke enough to need them. So today, we're pulling back the curtain. We're going to expose exactly why a $20,000 cash reserve makes banks nervous, what they do about it, and most importantly, what you should do once you have it. Stay until the end. This one will change how you think about money forever. To understand why banks fear savers, you first need to understand the game they're playing. When you deposit $1,000 into your bank account, you probably think that money is sitting in a vault somewhere, safe and sound, waiting for you. Wrong. That $1,000 is immediately put to work. Banks operate under something called fractional reserve banking. In simple terms, they're legally allowed to lend out most of the money you deposit, sometimes up to 90% of it, while keeping only a fraction in reserve. So, your $1,000, the bank lends out $900 of it to someone else, maybe as a car loan at 7% interest, a mortgage at 6.5%, or a credit card at a jaw-dropping 24%. They collect that interest every month, every year. And what do they pay you for the privilege of using your money? As of 2024, the average savings account interest rate at big banks sits around 0.45%. You give them $20,000, they earn potentially thousands of dollars per year using it. They give you back $90. That's the model, and it only works if you keep depositing, keep spending, and most importantly, keep borrowing. So, why does $20,000 specifically create a problem for them? Because $20,000 in cash savings is what financial experts call a financial cushion, and a cushion changes everything about your relationship with money. Let's walk through what happens. First, you stop being a fear-based consumer. The average American lives paycheck to paycheck. An unexpected $1,000 car repair becomes a crisis. And what do people do in a crisis? They reach for a credit card. They take out a personal loan. They pay 20% plus interest, and the bank collects. But with $20,000 in savings, that $1,000 car repair is a Tuesday afternoon. You pay it, you move on. The bank gets nothing. Second, you become less dependent on debt. Banks need you to borrow. A person with $20,000 saved doesn't need a financed used car. They don't need a personal loan for a home repair. They don't need a payday loan when things get tight. Every time you walk into a purchase with cash, the bank loses a customer for a loan and all the interest that comes with it. Third, you gain negotiating power. When you have cash reserves, you can shop around for better rates. You can switch banks without fear. You can say no to bad offers. You become a selective customer instead of a desperate one. That is the power shift, and banks know it. Here's where it gets fascinating and a little unsettling. Banks aren't passive. They don't just sit around hoping you'll stay broke. They actively engineer systems to discourage saving and encourage spending. Strategy number 1. Reward programs. Your credit card gives you miles, cashback, points. Sounds like you're winning, right? Except the average credit card holder carries a balance, meaning they pay more in interest than they ever earn in rewards. The points are bait. The interest is the hook. Strategy number 2. Low savings rates. When your savings account pays you 0.4%, there's no psychological reward for saving. The money just sits there, barely growing. But when you spend it and swipe your card, you get points, you get dopamine, you get the thing you wanted. Saving feels like nothing. Spending feels like winning. Strategy number 3, easy access to credit. Banks make it incredibly easy to borrow and incredibly boring to save. Pre-approved offers in your inbox, credit line increases you didn't ask for, buy now, pay later options everywhere you look. The friction has been deliberately removed from debt and deliberately added to building wealth. Strategy number 4, inflation anxiety. Banks and financial media often push the narrative, cash is trash, inflation is eroding your savings, you need to invest or you'll fall behind. And while investing is important, this messaging also conveniently pushes people away from holding a cash cushion and toward financial products that generate fees and commissions. Understanding these strategies is the first step to refusing to play by their rules. You might be wondering, why $20,000 specifically? Why not $5,000 or $50,000? $20,000 represents what many financial planners call the financial independence threshold for the average household, the point at which money stops being a source of daily stress and starts becoming a tool. Here's the math. The general rule of thumb is to have 3 to 6 months of living expenses saved in an emergency fund. For most American households, monthly expenses run between $3,500 and $5,000. That puts the target emergency fund somewhere between $10,500 and $30,000. $20,000 sits right in the middle of that range. It's the sweet spot. At $20,000, you can handle almost any single financial emergency, job loss, medical bills, car breakdown, home repair, without going into debt. You have the psychological freedom to take calculated risks, negotiate a raise, start a side business, leave a toxic job. You have enough to qualify for better financial products, higher-tier savings accounts, better loan terms, more investment options. You have time. Time to think instead of react. That is priceless. Research from the Urban Institute found that families with even $2,000 in liquid savings are dramatically less likely to experience financial hardship than those with none. Imagine what $20,000 does. It doesn't make you rich, but it makes you resilient. And resilience is what the entire debt economy is built to prevent. So, if $20,000 is so powerful, why doesn't everyone have it? Because the system, almost by design, makes it extraordinarily difficult to accumulate that cushion. Think about it this way. The moment you start earning a decent income, you're hit from every direction. Lifestyle inflation kicks in. You earn more, you spend more. Subscription services creep up. Eating out becomes a habit. The car payment grows. The apartment upgrades. Meanwhile, banks and retailers have spent billions studying consumer psychology. They know exactly how to make you spend before you save. That's why every store has a buy now, pay later option. That's why your bank shows your credit limit before your savings balance. That's why mortgage brokers show you what you can afford, not what you should borrow. There's also the debt trap cycle. The average American household carries over $6,000 in credit card debt. At 20% interest, that's $1,200 per year in interest payments alone, money that could be going into savings. The debt keeps people from saving. The lack of savings keeps people in debt. And this isn't an accident. Breaking the cycle requires doing something radical, paying yourself first. Before rent, before groceries, before subscriptions, you set aside a fixed amount, even $200 a month, and you don't touch it. You treat it like a bill you owe yourself. That's how $20,000 gets built, slowly, stubbornly, intentionally. Okay, so let's say you've done the work. You have $20,000 in cash savings. What now? Here's the playbook. Step 1. Keep 3 to 6 months of your living expenses in a high-yield savings account. Big banks offer around 0.4% interest. High-yield savings accounts, available from online banks like Marcus, Ally, or SoFi, currently offer rates between 4 and 5%. On $20,000, that's the difference between $80 and $1,000 per year. Same money, radically different return. Move it. Step 2. Set a hard floor and never go below it. Decide that $10,000 is your absolute minimum, no matter what. This is your psychological anchor. It gives you the freedom to handle life without panic. Everything above that floor is available for opportunity. Step 3. Start investing the excess. Once you have your emergency fund secured, additional savings should be put to work. Max out your Roth IRA. $7,000 per year as of 2024. Contribute enough to your 401k to capture the full employer match. That's free money. Then consider low-cost index funds through a brokerage account. Step 4. Use your cash position as leverage. With $20,000 in savings, you can negotiate, Buy a car with cash and negotiate a lower price. Refinance debt from a position of strength. Take calculated career risks. Launch that side business with actual runway. Step 5. Protect your privacy. This is one people don't talk about enough. Banks are required to report cash deposits over $10,000. If you're moving money around, keep records, stay transparent with the IRS, and consult a financial advisor for larger transactions. Your savings are yours. Just make sure they're documented properly. Here's the bottom line. Banks are not evil. They're businesses, and like any business, they're optimized to serve their own interests, not yours. The entire consumer banking system is designed around people who are financially stressed, living paycheck to paycheck and dependent on credit to survive. That's the customer banks are built for. When you accumulate $20,000 in cash savings, you quietly step outside that system. You become someone they can't profit from in the usual ways. You become someone with options, and options are power. The path there isn't complicated, but it is intentional. Pay yourself first. Cut the lifestyle inflation. Get your money into a high-yield account. Protect that floor. And then, slowly but surely, use that foundation to build something real. $20,000 won't make you rich overnight, but it will make you free in ways that most people never experience. And that is exactly what the system was never designed to give you. If this video opened your eyes, share it with someone who needs to hear it. Subscribe for more content that gives you the financial education the system never will. I'll see you in the next one.